Hi, welcome to this video today, which is all about how to trade Forex like a hedge fund. Now, it's a very common search undertaken by retail traders because they believe that hedge fund traders are the real elite traders and have a really fantastic performance. So by looking at their strategies and techniques, they can gain an edge with their own strategy. Now, the reality of hedge fund performance is not what most retail traders believe. They've got a fairly dire performance. I'll give it to you in a moment in terms of their performance over the last year, which is their best year in 3. And you might be surprised at how poor the performance is. Now, in terms of the strategies and techniques that they employ, I'm going to go through them. And when I'm going through them, you'll see that basically the best way for you to make money is to do the exact opposite to what hedge funds do in the markets. That might all sound a little bit confusing, but it will become clear as we go through some points in relation to their techniques and strategies. But first of all, before we do that, just want to show you their performance over the last year compared to other asset classes. So let's just take a look at their performance, and then we'll go and take a look at actually how they trade the markets.
Right, just on a simple comparison graph, it comes from Goldman Sachs comparing hedge funds with various other asset classes. And you can see hedge funds having a good year. They're up at nearly 6%, and it's a good year for them. If you look at hedge funds over the last 15 years, they tend to do, when they're having a winning year, single-digit gains, low single-digit gains. There's losing years in the last 15 as well. Not a great performance, is it? You'd be better off in mutual funds or even tracking the S&P. Why is the performance so dire? Now, if you look at hedge funds in yesteryear, back in the late 1990s, for example, you had funds like George Soros's Quantum Fund. Well, that was doing 100% compounded per annum in terms of gains. You had other great funds around like Ed Thorpe's Princeton, EDF Man's Mint Fund, huge amount of funds, or big amount of funds, doing great gains with not too much drawdown. Those hedge funds have gone, obviously, and the new breed of hedge funds over the last 15 years, dire performance. Why? All those resources. Well, it's to do with partially the way the markets have changed and how hedge funds have switched their way of trading or their techniques. Okay, when you understand how hedge funds trade, you can actually see how you can put a strategy in place that can beat the average hedge fund, not just by a little bit, but by a lot. Now, this will become clear when I go through the points in relation to the way hedge funds trade. I've written them up on a storyboard. So let's go and examine the points in more detail. And you'll see the best way to trade the Forex markets if you want to make money, and you're just going to do the opposite of what hedge funds do, not the same. Okay, right, let's shift over to the storyboard. All right, let's have a look at how hedge funds trade. Just as a general rule, there obviously are exceptions to the rule, but in terms of points, let's go through them. Today, technology has changed the hedge fund industry over, let's say, George Soros's time back in the late 90s, and technology means that hedge funds have moved to shorter term trading. You've seen really the rise of the high frequency trading programs and systems. Hedge funds use them heavily, and they're in response really to the reduction in dealing fees. Transaction costs for trades have come down dramatically over the last 20 years, which is actually good news for us as retail traders, but not good news for hedge funds. Now, come to why it isn't good news for them in a moment. Now, in terms of most hedge funds, they do not hold longer term trends at all. They're shorter term traders. They might actually have a long term view that gold is going up, or maybe the Aussie dollar is going down, but they're not just simply going to buy gold and hold it. They'll buy it, sell it, buy it again, sell it. They'll keep turning over trades. Now, the reason that they do this is they're very focused on commission to equity. Now, what commission to equity means is that a hedge fund will have an overhead, and they'll normally have a figure in mind that they want in terms of fees against that equity. So If they've got, let's say, 100 million and the commission they want is 30%, they'll want to generate 30 million in the market in terms of fees. Now, in terms of generating fees in the markets, HFT trading systems are very good at doing it. For example, they do hundreds of orders, buy and sell in the time you can blink your eye. Okay, so they're very focused on generating commission. Okay, it's basically referred to as churn and burn. It basically means that if you've got commission to equity as high as 30%, I'll come to where I got this figure from in a moment. You're going to generate 30% in fees. Okay, so you're going to basically drop the fund's value by 30%, aren't you? So you're going to need to make 30% in the market to cover those fees, and more money on top to give the client equity a profit. So you're going to make 30% to break even. Now, Simon Lecker exposed the hedge fund industry. A lot of people knew what he said anyway, who were in the industry, but he kind of made it sort of common knowledge, let's say, to everyone else, that most hedge funds are aimed at that commission to equity as a target. And of course, that is detrimental to performance, isn't it? That's why they can't produce any decent gains. And Simon Lecker was saying, he's actually a hedge fund manager himself and a successful one as it happens. He's saying, this obsession with fees means that the hedge fund industry obviously doesn't perform. The actual reported hedge fund gains or losses are actually worse in terms of losses and less in terms of gains, because in that composite they take out all the hedge funds that have to shut down due to accumulating too many losses. So they're obsessed with commission. Now, in George Soros's day, what was different? Well, there wasn't that obsession with or the ability to turn over that many trades so quickly. Also, it was a different era, so to speak, where hedge funds very much focused on, if the client makes money, they'll make more money. So they very much focused their fee remuneration on having a chunk of the performance and a management fee. They have quite a decent chunk of the performance. 20, 30% wasn't uncommon. But at least it showed that they were confident in making money for the client. That was their focus, not focus on just making fees and eating into the client equity. So lessons from hedge funds, the real way to win. Well, you probably guessed it, haven't you? Commission, dealing fees are not important to us as retail traders. We get great commissions or spreads or whatever you want to call them. Obviously that's an advantage to us. It's not an advantage to the hedge funds in terms of the way they trade, obviously. But we can actually be very patient. We don't have to trade for fees. We're trading to make money from the markets. And patience is something that most traders don't learn. How often do you really have to trade to make decent gains? Not very often at all. You want to be very selective and have a longer term focus. You don't want to be trading too short a term. No, loads of traders who make 30% per annum, 50% per annum, really not trading that much at all, just maybe a few times a month. In terms of the markets today, they are extremely noisy. Okay, and HFTs create a lot of that noise. Also, instant trading does as well. So if you're trading too short term or try and do it too consistently, like every day or whatever, you're going to lose money. Okay, hedge funds have the advantage of if they lose money in the market, they're making money in the fees. You don't have that advantage. So you want a bit of a longer term focus. I'm not saying you can't make money doing a trade in a day. Of course you can. But you can't do too many trades in a day or do it every day and make money. Okay. So you want to be a bit longer term in your focus and stay out the way of the noise, which means swing trading, holding trades, that are correcting overbought or oversold. Probably take a day or two to a week. you can follow longer term trends. They're there for a few weeks or more. Yeah, just be very selective. You have a very simple strategy as well, and you can make money. Now, in terms of swing trading, long term trend following, and doing it simply, we do numerous videos where we give our trades in our exact levels of entry, stop, and target online. You can see that we do come out ahead over the longer term. Yeah, sure, we have our losers, but we're aiming for decent percentages from our trades, okay, in terms of the profit, okay, because obviously we know we're going to have our inevitable losses. And I think too many traders, beginners in particular, in awe of the so-called big boys. There's nothing to be in awe of people who basically trade to make money from client equity, to fund lavish lifestyles, nice offices, huge bonuses. It's just nothing to be admired, and the tactics that they use you can't use, so you just don't want to be in awe of them, or think that they're better than you. Yeah, sure, they've got all the technology, they've got all the research, but the acid test in terms of trading, in the real sense, is making money from the markets, which they can't do. How much money can retail traders realistically make? You've got really great advantages, I've said, in terms of really low dealing fees. Fantastic service from brokers, in my view, today. And there are still trends in the markets. Just got to go away from the noise. So I did mention earlier on that I know traders who can make 30%, 50% from markets. Everyone's different. I know traders who can make over 100%, for example. Everyone is different. But you certainly beat the 6% that I mentioned earlier on. That's a very low benchmark, though. I think you can do better than that. I said it in previous videos, depending on the risk you're prepared to take without going, how would I put it? Getting too risky in the markets, or taking too much risk. 30 to 100% per annum. Okay, that is what I've seen the best retail traders I know do, and they do it consistently year on year. Can you do it? I don't know if you can or not. Like I said, everyone's different, but I think that everyone can certainly make more than the average hedge fund. So that is the video for today. Thank you very much for watching me as usual. Take care. Have a good day.